Also talk to you about the trade data. The deficit has indeed widened, but it's also signaling a revival in the economy, is it not? Because imports, not just gold imports, but plant machinery, etc., have also gone up quite significantly.
Well, the fact that the trade deficit has reached a 30-month high of $13.2 billion could be the beginning of worry. The important point to note is that the rupee has appreciated significantly compared to many of India's trading partners. A benchmark would be China. Against China, over the year, India has appreciated, the rupee has appreciated by 10%. And while that has still meant that our exports are doing better than they did a year ago, that's because destination countries like Middle East are better off than they were a year ago. Exports have grown 19% year-on-year, but year-on-year imports have grown 49%, and that indicates that a cheaper dollar means it has been easier to import a whole lot of consumer durables. Goods that have been cheap and that have shown a substantial growth have been electronics, grown from 2.4 to $4.5 billion year-on-year. Likewise, pearls, gems and precious stones have again doubled from 1.2 billion to 2.4 billion. To be fair, it's not just consumption goods that have become cheaper to import. We're also seeing higher imports in chemicals, coal, machine tools. All of them have grown by about 30%. So maybe there is a slight uptick in industrial activity. But the important point is that as the dollar gets cheaper, it may become cheaper to import. So these machine tools and this coal is actually competing with domestic industry, and perhaps domestic industry is losing its market to imports. That's why the big trade deficit at 13.2, it is still tolerable and will give a current account deficit under 2%. But if it goes to 14 and 15, we have cause to worry.